I want to bring in someone who's uber bullish on stocks, Stephen Auth, the Chief Investment Officer of Equities at Federated. And Stephen, where do you get, I mean, after all, okay, so after this jobs report, where do you get your optimism from? I was going to say, where do you get the idea?
Actually, the whole week has been, the last 2 or 3 days, Betsy, we've seen counter-trend moves in everything. U.S. dollar, oil, U.S. GDP number, which basically, came off the boil in the first quarter. I think this jobs report establishes that we're not falling off a cliff there either.
Okay.
And those were what was giving the stock market pause at this 2,100 level. We've gotten through the earnings season. It turns out it was actually not as bad as people thought it was going to be.
So after today, you think it's all clear?
Well, yeah, I think now you've got a period of stability on the dollar. The dollar grinds higher from here, but more stably. U.S. interest rates, I think, have peaked for the near term. We're probably going to in a 2 to 220 range now.
Right.
The oil has established, I think, a nice range between 40 and 60. That itself might be the sweet spot for oil. Good enough for the U.S. energy sector to keep growing, low enough for the gasoline tax dividend to come through for the summer. I think we're in a kind of really nice period here for equities between here and the end of the year.
Why do you think the analysts were so pessimistic about this earnings season? I mean, obviously the energy companies are the big story, and I've read a lot of people who have said, well, energy companies all cut their forecast. Analysts are to some degree beholden to, a slave to what the company forecasts are. And the beneficiaries of lower oil hadn't done the opposite as much. Is that really all, as simple as that?
I think it was that and the dollar. And the dollar, the analysts always have trouble with the dollar, but people really overestimated the impact the dollar would have on the U.S. exporters. So they were bringing down numbers all through the first quarter. I mean, December of the first quarter, we were projecting plus 12% consensus for earnings in the S&P. By the time we'd gotten to the end of March, we were, I think, -3. So it was a big downgrade. And we're coming out better than that. In fact, ex-energy, the earnings were up 11% in the first quarter. So people really, I think, overestimated. They overreacted. That gave stocks a pause along with everything else. But now, we're looking through to the end of the year. We think earnings will probably end the year 125 on the S&P. Mm-hmm. More importantly, 135 next year. And on that basis, stocks at, 17, 18 times earnings, we think are pretty cheap. And if you look at a lot of the large cap stocks, there's still a lot of value in this market. The people think there's no value, especially relative to bonds.
Where are you seeing the value?
We see it in consumer discretionary names, Home Depot, Macy's, even Amazon. We see it in the healthcare names, which had a nice pullback here, as have the discretionary names. But the healthcare names have all pulled back. A lot of those Gilead, trading at 10 times earnings, Celgene, okay, a little more expensive, but great growth.
Yeah.
The tech stocks look good to us, and financials. I mean, J.P. Morgan trading at 10 times, big beneficiary of higher rates and an improving economy. I think that, I don't know, people are just pessimistic. 08-09 was a crisis. Everyone thinks it can't keep lasting. We think we're in a secular bull market.
So you think we're all just haunted by what happened then?
I think we are haunted, Betty. I think
Bob's haunted.
I'm haunted.
Because Bob is haunted.
I'm haunted. I'm haunted. I see. You say clear sailing. I want to know, what's the one rock up ahead that you're a little bit concerned about? I don't want to rain on your parade, but what's that one thing that
the iceberg?
The iceberg.
Yeah, the iceberg. Oh, God.
The unsinkable
There are always
bull market.
plenty of rocks out there, Bob, but one is China.
Okay.
A crash in China
growth
would be bad. Slow growth is fine. I mean, we're not big investors in China right now, other than in some of the smaller cap stocks, but generally speaking, I think China is not a great destination for equities, but we do have a giant amount of money out there to engineer a soft landing. But, a blow-up in China would be a problem. We don't see it happening. Europe could blow itself up with Greece. I think it's just headline risk. I don't see that happening. I think the emerging markets have come through a rough time now. We're not overly bullish on emerging, but I think we've kind of made through the worst there. I think we're okay.
What's
Does that convince you?
Well, what's amazing to me is every time, you're selling, somebody else is buying and vice versa. So I'm the guy who's selling and you're buying.
Yeah, you've been doing that all the way up. We went overweight equities back in 09, so
Yes.
Yeah,
well,
but
good.
thank you.
Good for you.
Yeah.
Yeah, no.
There you go. Okay.
It's a beautiful spring day in New York.
Let's just all go grab a beer at the end.
Yeah, this is fantastic.
That's it. All right, Stephen Auth, thank you so much. Chief Investment Officer of Equities at Federated. Thank you. And thank you to Mike Regan as well as Bob Ivry.